Good evening and welcome to Budget and You. This space at 7 p.m. every day is dedicated to you for the rest of the week. Any question you have about your money, you can call us. There's a number at the bottom of your screen. You can tweet out your question as well. You can, send it to me on Twitter, or you can send it to ET Now Live. Joining me today to answer your questions for the next half hour is Dhirendra Kumar, the CEO of Value Research. Dhirendra, good evening to you and thank you so much for joining us. We're of course looking at a countdown now before the big budget announcement, and I know that it is something that makes a lot of investors both excited and a little nervous. They're wondering, of course, since we've read in the papers, if it's likely we'll see a higher tax benefit come in, or if there's going to be some sort of interesting push perhaps for equity investments. Again, this is something we've read in the papers as well. What are you leaning towards right now? Do you believe that there'll be anything drastic in the investments or the personal investments space?
I hope so. I'm not expecting a big tax break coming into the way of individual investors, simply because last year the makeshift, the last budget, and not long ago, effectively, individual investors got a hike on the tax limits by 50,000, and then the ATC limit got enlarged. So from that standpoint, I think I don't see a logic, but I would expect more methodical and systematic approach to all these things. I would expect that this government does some few things which are of permanent nature. For example, all these limits, every year individual investors tend to expect a revision. I would like them to be indexed to something so that they automatically get revised. Your ATC limit should get revised every year automatically based on some index. Likewise, these limits should also get adjusted with inflation, because 2.5 lakh rupee today, which is a non-taxable bracket, which should automatically get revised to something every 3 years or something like that, so that it should not be dependent on a finance minister. He should not be wasting his time on something mechanical and mundane as this. And investors will also have a very clear, investors, savers, taxpayers will have a very clear premise what to expect. It will bring about great degree of predictability. On the savings front, I expect that there is a big distortion in the market. We depend on FIIs substantially for the investments in our equity market. All the domestic savers, their long-term contractual mandatory savings, whether it is coming into NPS or the EPFO, we see a huge distortion here. EPFO money, which is basically private sector employees, right, is managed by the government, which tentatively gives a fixed income. Government employees' money is managed by private sector pension fund managers, which is also very nominally into equity. So long-term savings doesn't get channelized into equity.
All right. Two main messages for our finance minister there. We really wouldn't like you to spend your time tinkering with the tax slabs. Dhirendra, they're making it very easy. If you can link it somehow to the consumer, inflation index, the CPI, that would be great. We wouldn't be something that we have to ask for before every budget. And of course, pension reforms is something that's fairly high on our mind. Now, remember, like I told you, if you have a question for us right now, you can tweet out your question at Faye D'Souza, Faye D'Souza, or at ET Now Live. And we have a live phone line that's open as well, 022-249-25089. That's on your screen. Pick up the phone, call us right now. It'll be our pleasure to hear from you. And I'm told we have a phoner on the line right now. Hello, could you tell us your question? Go ahead.
Hello, yeah, this is Shailesh over here. I actually earn around 75,000 per month, and I am investing in SIPs for 12.5K. So looking at the budget for the next financial year, I need to know, should I invest in a property for around 20 to 25,000, or should I invest in SIPs or mutual funds for 20,000?
Okay, Shailesh, tell me this. What is your time horizon on this, on this investment? Is it something?
4 to 5 years.
4 to 5 years. Are you sure it can't be any longer than that?
No, it can be longer, but minimum is 4.
Okay, and what sort of risk appetite do you have?
It's 100% risk appetite I have.
100% risk appetite. So, okay, Dhirendra, this is interesting. He has 100% risk appetite. He has about 4 to 5 years as a time horizon. He's willing to stay longer. The interesting thing is, we found out that, property, residential property is not going to give us any more than maybe 5 or 6% in different parts of, the country. Would you rather he, focus on equity then?
No, absolutely. I would say that nobody should consider a home as an investment today. If you are likely to live in that house and if you are likely to get that delivery, consider it. you get many more returns, than just financial return, the emotional comfort and a goal being achieved from that standpoint, and you start saving on the rental. In that sense, it could be worth considering. Otherwise, don't consider property as an investment, more so something for which you will borrow substantially. And it will be a huge compromise on liquidity. So I would strongly urge you to consider, 3-4 funds, do your SIP, and hope that the market keeps doing well. And I'm confident that, when you look at the combination of things, one is that you will be under no pressure of an EMI, because your investments is not an obligation. Making an investment is not an obligation. You have not built any liability. The other is that it will be completely liquid. The third is that, it will be completely tax free. If you hold it for 4 years, 5 years, then, your SIP will accumulate and you will be able to average your investment. And I'm extremely confident about next 5 to 10 years about the equity market. We haven't seen this kind of, if this government continues and prevails, then I think, these are perhaps unusual time for the equity market.
Dhirendra, I'm going to put you on the spot like I always do and ask you to recommend 1 or 2 funds that he can use as an SIP. Remember, he said he could stay more than 5 years. I'm going to ask him to put his hand on his heart and give us at least 7 years on this investment. What would you like him to do? Could you give him a couple of funds that he can focus on?
I would say that, he should simply replicate our growth portfolio. And growth portfolio is made up of 5 funds. Maybe, if he has his fixed income investments elsewhere, he should just drop the fixed income fund where there is a 20% allocation and spread the remaining money into the other 4.
All right, so there's your answer, Shailesh. Now, just to give you a quick recap of what we talked about, remember the fact that real estate is not going to give you great returns over the next few years. It's illiquid, there's a high tax component, and it's also a fairly fiddly asset. There's a lot of maintenance that goes into it, time, energy, and that sort of thing. Dhirendra making it very simple for you, our growth portfolio, which I'm going to put back on your screen right now so you can take it down. This is our growth portfolio. He says, put your money in these funds and you'll be completely sorted for the next 5 years. Does that help?
That would be great. And can I know one more thing?
Sure, go ahead.
What returns would I be getting around, say, 5-7 years if I stay down the line?
I wish we could tell you exactly what equity would give you in 7 years. Dhirendra, do you want to hazard a guess? Can we expect at least 12% annualized over 7 years?
It's hard to guess that, but I'll be very happy. My expectation will be that I should be getting 1.5 times more than the prevailing fixed income rate. And the whole magic of compounding with your averaging will actually boost your return. So I would say that will translate into something substantial, because you don't have all this money at one go. You are accumulating it gradually. So with an all equity fund, expect at least 75% more than what the prevailing fixed income. But return from equity is entirely a function of what is the risk-free return option available. If interest rates in this country comes down to 5% over the next couple of years, then even 10% return will look very handsome.
All right, Dhirendra, I'm going to ask you a very quick question that's coming on Twitter right now. This is Candid Tarun has asked us a question. He says, what type of mutual fund can alter or change its portfolio of stocks or instruments very frequently based on the stock price? So he obviously wants to know what sort of a dynamic mutual fund can he invest in. Would that be the dynamic funds then, Dhirendra? Would you recommend that that's something someone like him should look at?
Yes, but there are many kind of funds. In fact, every fund manager changes his portfolio depending on his outlook, and there are fund managers with long track record. There are fund managers with not so long track record, but fairly impressive return even in the medium term. If his basic question is if he's asking of funds which actually change allocation, changing allocation meaning moving his emphasis on equity or debt depending on the market outlook, yes, dynamic bond funds could be useful. Don't consider the asset allocation funds which take a big bet, either they are 0% into equity or 100% into equity, and they can swing in that broader range. Those funds don't work well, and I don't think they have proven their credentials yet. But I would say that funds which work in a very narrow range, they change their allocation to equity and debt, but in 10 to 15%, those funds will actually do better.
All right. Now, remember, if you have a question for us right now, you can send it to us either on Twitter or you can call us on the live phone line that's on your screen at this moment. Just pick up the phone and call us. It'll be our pleasure to hear from you. In fact, I'm told again that we have a caller on the line. Hello, could you tell us your name and tell us your question? Good evening.
Good evening. This is R.K. Patil. I am 57 years old and I am likely to retire from my job after 1 year. I have a corpus of 24 lakhs at the moment, which I would like to invest in mutual funds. The idea being to generate a regular income after 1 year for monthly expenses. And the second part of the question is, given that the current financial scenario is good, the market is doing well, does it make sense to invest this 20 lakhs as a lump in various schemes vis-a-vis staggered investment? Please advise.
I have a very quick question for you. Do you have any other pension that will start to pay out after you retire, perhaps your PF or some sort of pension that your employer would provide for you?
I have a few endowment insurance policies worth about 30 lakhs, which will be coming after about 2 or 3 years.
So this will be your only source of regular income for your monthly expenses?
Yes, yes.
All right. Dhirendra, he'll only be 58 when he retires, which means the senior citizen savings scheme will not be available to him for the next 2 years at least. So if he's generating a regular income from a mutual fund, what would you like him to consider?
No, one is that, there is a possibility that, senior citizen savings scheme will be available to him if he is actually retiring at 58. And but the maximum investment that he can make there is 15 lakhs and that will earn him about 9%. So that will translate into, a return of something like 13,500 rupees per month. And he will be getting this return on a quarterly basis. The interest payment is on a quarterly basis. He will also be under the, below the taxable limit. So that should be his first destination, because no mutual fund, no other market-linked investment can provide him guaranteed a monthly income on which he has to bank upon. So that should be his first destination, and I think, he should work towards this, that his 15 lakh goes there and generates that return. Remaining money should find its way into equity, because he has another problem. This 15 lakh rupee which will be producing income will not be enough after 5 years, because his principal will, because of inflation, this 9% return on his 15 lakh rupees investment will not be enough. That has to get revised upward with inflation, which means that he will be needing more capital over time to supplement his income or to balance the need. So that will be taken care of by his remaining investment in equity. So all his subsequent investment, where, the 5 lakh rupee which will be left, of the 24 lakh rupee, 15 lakh rupee goes into senior citizen savings scheme, 9 lakh goes into equity. And about his equity investment, he should never be investing in his lumps as a lump sum, because markets are extremely predictable. More so, you will be very anxious about your investment if the market goes down and you have made your 9 lakh rupees lump sum investment and it goes down by 10%. You will not behave in a very normal manner. So you will be tempted to take your money out, making your losses permanent. So it's a very dangerous thing to do. One must always be averaging one's investment. And for somebody like you, not only should be investing in equity, but should be investing in equity in a conservative vehicle. So I would suggest somebody like you to consider a balanced fund rather than an all equity fund, and definitely spread your investments. And the proceeds from the endowment policy should over a period get into this equity portfolio in a calibrated manner.
All right. Dhirendra is giving you some very, very clear advice. We hope that helps. Thank you so much for calling us. Dhirendra, very quickly, I'm going to squeeze in a question that's come in on my Twitter account. What will the cost be if I take an SIP of 5,000 rupees a month in a tax saver fund starting next month? This is an Ask Me Anything show. It's a fairly basic question. There's obviously a cap on that cost. But for any sort of tax saver that we take right now, what would the cost be, Dhirendra?
No, there are costs, and there are significant costs, because 100 rupee transaction cost is a legitimate thing. So if he is going through a distributor, 100 rupee is the transaction cost for your first investment by way of SIP. But otherwise, assuming that you are an investor who is able to make the investment direct, so your cost generally ranges between 2 to 3%, but you don't get to know that because you don't write a separate check for the cost of a mutual fund. it is deducted from the expenses of the, the expenses of a mutual fund is deducted from the NAV on a daily basis, and the annual cost, which you don't get to know, it only gets reported, ranges between 2 to 3%.
So we hope that helps. Now remember, quickly before I go into break, there is a phone line at the bottom of your screen where you can call us if you have any questions. You can also reach us on Twitter. Both Dhirendra and me are available on Twitter. Just look for our names. Coming up after the break, more questions and answers. We're waiting by the phone. Call us. Welcome back. Good evening. You're watching Budget and You. This is a personal finance corner we've created every evening between 7 and 7:30, where you can pick up the phone and call us and ask us absolutely anything at all about your money. Dhirendra Kumar is with me, and of course, you know, our Twitter accounts are open. There's at ET Now Live, where you can send in a question, or you can send in a question to me or to Dhirendra Kumar on Twitter as well. We're waiting to hear from you. Dhirendra, we have a question that came in on email. Satish has written in. He's 55 years old and he has around 7 lakhs to invest in mutual funds. He wants to generate quarterly dividends, he tells us. What sort of mutual funds should he be investing in ideally? So he hasn't told us anything about, you know, beating inflation or how long he wants to keep this money invested. So for someone who's looking to create quarterly dividends out of their investment, what fund should they use?
No, one is that, you know, how badly he depends on that income. If that quarterly income is something which is a necessity, then there's a completely different approach. He should be looking at bond funds, or he should be looking at a fixed deposit for that investment. But if his need is to, you know, if he'll get, you know, a quarterly return of whatever, you know, anywhere ranging between 10 to 12%, and he'll be fine. And if he's not overly dependent on that for something essential, then he should consider, you know, something which is market linked, will be tax efficient, and will be optimal, you know, will be substantially enhanced return. If his need is of the second kind, that if he'll be happy with some decent return, he should consider a balanced fund. One important thing which, you know, which I should remind him, that it doesn't matter, you know, you should not be looking at dividend from mutual fund. Dividends in mutual funds don't matter. Performance of a mutual fund matter more, because you might get dividend from a mutual fund after investing your 7 lakh rupee, but there is a possibility that it is returning your own money, you are getting your own money back, the investment might go down in value, and getting a dividend doesn't serve the purpose. You should look at a consistently performing fund which does well, and you should derive that return at a time of your choice. And dividend is nothing but getting your money back, and your principal actually gets offset by as much. So don't look at dividend as a criteria. Consider a well-performing fund with a stable track, you know, which provides return with stability. A balanced fund is with a higher risk. Consider an MIP, the growth option, if you want to be extremely conservative with that. If you need guaranteed return, consider a bond fund or a fixed deposit.
A balanced fund or an MIP and a bond fund if you want to be really, really conservative. In fact, Dhirendra, I'm told we have a phoner on the line right now. Hello, what is your name? Where are you calling us from?
I'm calling from Bangalore. My name is Dev Roy.
Hi, Dev. I'm from Bangalore as well, by the way. It's nice to hear from you. Tell us what your question is. How can we help you today?
Yes, first of all, thanks a lot for the wonderful show, Investor Guide. And it was like my dream to speak to Mr. Dhirendra Kumar, and I don't know, it was my lucky day today. Okay.
It's our pleasure.
Yes.
Tell us your question.
My age is 26 years, salary take home is 35,000, and I am investing 20,000 per month in mutual funds. I am an experienced mutual fund investor and investing only in mutual funds. I'm looking for funds that has less beta and consistent alpha. Second is, I'm of the opinion that funds with more than 30 to 35 stocks with majority in cyclical sectors contributes more towards the beta than towards the alpha. So based on my experience and analysis, I have selected 3 funds. Motilal Oswal most focused mid-cap 30%, Birla Sun Life MNC 30%, Birla Sun Life Banking and Financial Sector Fund 10%, that is only for 7 years, looking the market into consideration, and Reliance Pharma Fund 30% for 25 years. I know these funds are not been recommended by any of your shows till now, but I have seen this performance really coming into picture in all of these funds.
All right.
Thank you so much.
So you want us to tell you whether this is a good selection?
Yes, for 25 years, except the Birla Sun Life Banking and Financial Service Fund for 7 years.
Okay. All right, Dhirendra, I see right off the top, I know that there are two things you're going to have a problem with. One is a thematic fund, which is the banking and financial sectors. There's also the Reliance Pharma Fund. The other two funds that, are fairly, this thing are the Motilal Oswal focused mid-cap, I think he told us, and the Birla Sun Life MNC. Given everything he wants out of these investments, would you say he's on the right track? Would you like to simplify his choices a little bit?
No, one is that, his first two funds, I'm extremely hopeful. I'm very hopeful. In fact, Birla Sun Life MNC has a very credible track record. It just doesn't happen to be a very well diversified fund. It's a thematic fund which says that it will be investing only in multinational companies, but it has an impeccable track record. So it's a good fund worth holding. And this fund by its design, because, there was a time when this fund was launched where the MNCs were more fancied companies for their superior corporate governance, but today we have plenty of Indian companies which can match those. Besides that, most MNCs operating in India have a very focused approach to business. Although, most MNCs don't become conglomerate, they don't become diversified businesses. They are focused onto a specific sector or a industry, and they remain one. So from that standpoint, Birla MNC fund is a decent fund, though it doesn't happen to be in any of our mainstream diversified category. Motilal Oswal Select Mid Cap is an excellent fund, but has a very limited track record, and we actually be very conservative when choosing a fund. We look at a reasonable track record to form a view that it is a worthwhile thing to recommend. But I'm hopeful that these two funds are good funds to have, and they should prove to be worthwhile investment. I'm not very sure about the other two, because when you pay mutual, you are incurring the cost of getting your money managed, and you are holding the key decision to invest only in financial services, because a diversified vehicle will also get you the diversification in a relevant way, and pharma and financial services are fairly mainstream sectors.
Right.
They are adequately or sometimes more than adequately represented in any diversified portfolio.
All right, so that's the advice, and this is the advice consistently that we always give you. The other two are fine. Stay away from the thematic funds. Dhirendra, we've run out of time on the show this evening, but thank you so much for joining us live and answering our questions. Dave, we hope that helps. And remember, we continue to answer your questions like we've done for the last 6.5 years. Our email ID is at the bottom of your screen. Tomorrow, Andrew Holland joins us in the studio. He's the CEO of Ambit Investment. He's going to help you with your strategy. So if you have an investment strategy question, feel free to join in tomorrow. Thanks for watching.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.